Hello friends, my name is Behroz and in today's video I will talk about the stock market steep decline, almost a 10% decline that we saw in the stock market, wiping out all the gains that happened in 2025. So for 2025, the market is in the red now. I started receiving a lot of questions from my WhatsApp community with regards to what should we do, should we sell, should we buy, should we just hold? And there was some panic as well. So instead of responding to them individually, which I also did, I thought it would be best to make a video for all others who are not on my WhatsApp community to also get an idea as to how they should operate or what actions they need to take as a prudent investor. Now, before we go into the details of what should you do, what should be the action for you as an investor, I think it is important first to understand what kind of investor are you and what is your investment strategy. So let me break it down. There are essentially three investment strategies. One is you are luckier than others. So for instance, if you're kind of a person who would participate in a lottery or a raffle and they end up winning the raffle or the lottery, if you are that person, then this video is not for you because I don't have any strategies for how you go about investing if you are lucky, because I'm not lucky at all. I'm not the person who would participate in a lottery or raffle and would win. Maybe once in a while, once in a blue moon, I would win, but that would be a very fluke or a big chance that I would be winning. Otherwise, normally I don't win. So I'm not lucky. I don't consider myself lucky in terms of me just blindly purchasing some stocks or investing and then it just popping out in terms of returns and giving me massive returns. That doesn't happen to me. So I'm not the lucky investor. If you are the lucky investor, this video is not right for you. If you're not the lucky investor like me, then continue watching. The second strategy is that you are smarter than others. And here I just won't say smarter, it's also that you are also ready to put in the hard work. So a smart individual would be someone who understands business, someone who understands companies they're investing in, they can read the balance sheet, they understand the numbers, they understand P&L, cash flow statement, everything, like all the statements, financial projections, they understand everything. So this is one. Or second, they are ready to put in the hard work, which is they are ready to review all the financial reports, historic reports, future reports, kind of like future projections. What is the strategy that the management is taking? What is their plan for growth? Or what is the trend in the market? All of this. Now, this requires a lot of time. I don't have that much time. One, I'm not that smart to really pick out a number or pick out a needle from the haystack and find that Uber or Google or Amazon when it is small in size and I'm able to pick that company. And second, even if I'm smart, I'm not ready to put in the hard work which is required because I have a day job, I have a family, I have other passions as well, other hobbies. So I don't have time to invest in understanding the financial reports of a particular company, the trends in a particular industry, understanding their strategy, all of this. This I cannot do. So if you are like me, who's not that smart with regards to understanding a particular business, plus is not ready to put in the hard work, then again, continue watching because I will talk about the third strategy. The third strategy, that is the only strategy which is left after you've told yourself or agreed that you are not the lucky one, you're not the smarter one, then you are the one who has to remain patient. So you have to be patient for you to earn returns. And this is who I am. I can be patient. I can be patient with returns. I don't need returns like tomorrow. I'm ready to invest for the long term because I know I'm not lucky, because I know I'm not smart. So the only strategy that I'm left with is to be patient. And this is what I do with the stock market. I don't see stock market as an investment that I do today and it will give me return tomorrow. Rather, I look at it from the lens of at least a decade, or if nothing else, even more. So have a 10-year horizon when you're investing, saying I'm investing now and I expect to get returns from this investment on a long run basis, over 5 to 10 year basis, as against saying I invest in Jan and I expect the returns to come in March. Now, one important call out, in case you find any value from this video, please press the like button as this keeps me motivated. And more importantly, if not done already, press the subscribe button, because on this channel, I post content pertaining to how you can achieve success in your career and build wealth. So if any of these topics are of interest to you, then this channel is right for you. Now, since we've established the fact that we are a patient investor and we are okay to be patient, let's talk about some of the things that we don't know. And then we'll talk about the things that we know, and basis that we'll decide what should be the right action. So things that are unknown to us is we don't know how and when the market will fall down. It will fall at some point in time. It will go up at some point in time, but we don't know when and how. This is an unknown. It's not just I don't know this. No one knows this. Second is we don't know how low is low. So market has dropped around 10% roughly from its high. Can it go down further? Another 5%, another 10%? Yes, maybe. Will it stay here? Maybe. Will it go further up? Maybe. We don't know all this. So it's not like the dip is here and let's start buying. It could dip further. This is another unknown that we have. And the third unknown here is that we don't have access to information or special information which no one else has access to. So all the information that is available there, we know that information. Or maybe let's say all the information that I know is already available to the market. So the market has already priced in that information in the stock price, in the price of the market. Hence, I don't have a specific advantage in the market by having access to information which no one else has. Like this particular company is about to buy some land or some investment that they would be doing. This is a very secret kind of an action that a company would be taking, and I don't have knowledge to that. Similarly, I don't have knowledge to what kind of policies the government will be making which will impact the stock market. All the information that I know is already accessible to the stock market, and hence it has already been baked in or priced in the stock market's value. Now, these are the unknowns. One is we don't know when the market will go up, when the market will go down. Second is we don't know how further it will go down. And third, we don't have access to special information. Now, let's talk about what are the knowns. The knowns are that the market always goes up. If you take, let's say, S&P 500 for an example, for past 100 years, it has been growing by 10% on average year on year. Now, there are years when it's down, when there are years when it's steep up. However, on average, it is still going up. So down, up, but on average, it continues to go up, which means again, for the long-term investor, it will always continue to go up. And the second known that we have is that the markets are always bipolar. They react or overreact to any news and create panic at times as well. And this is what just happened now as well. So the market created panic and market went down almost 10 to 12%. And now it's kind of gotten back by around 2 or 3% up again. So whenever there is such a massive news, the market behaves or overreacts, and it's bipolar. They forget that they need to be going by the information that is available, rather they just overreact and overcorrect themselves. Now, we have these three unknowns and we have these two knowns. Knowing what we know, knowing what we don't know, how should we go about investing in the stock market given the recent decline that we've seen? So now let's apply all this logic and knowledge that we have to what should be the investment strategy. Question number one is, should I sell and cut my losses? Well, the answer is no. One, you don't know whether the dip has already come or the market will dip further. Now, you expect the market to dip further, you want to sell out, but as we said, this is an unknown. So since we don't know whether the market has dipped already or not, you don't want to cut your losses now and sell and realize that the market is started to go up, because this was the base. And as soon as you sell, the market starts to go up. By the way, this is the reason why S&P 500, let's say, has been performing 10% return on average annually, while the investor earns lesser return. Even when they're investing in the stock market in S&P 500, their returns are lower than what S&P 500 has delivered. And this is only because the investors do in and out. So when the market is going up, they think, oh, the market will continue to go up, they buy. And when the market is going down, they think the market will continue to go down, they sell. So they buy high and they sell low, and that is why they're not able to match the performance of S&P 500 trajectory. Typically, S&P 500 has been growing by 10% year on year, and a normal investor, if they're investing in S&P 500, on average makes around 6% to 5% return, and that is only because they are selling and buying at the wrong time. So do not sell. You don't know whether the dip has come or there is more dip. We don't know that. Hence, selling is not a good strategy here. Now, here's one advice for you in case you cannot handle this kind of volatility. One is you stop watching the news altogether. The more news you watch, the more anxious you'll get. And if you can't do that, then the second is look for assets which are less volatile. It can be in some stocks as well. There are some stocks which are less volatile, and also maybe preferably investing in bonds. So invest in assets which are less volatile. And in this way, while you will be earning less returns, the investment will be less risky, and hence you will be less anxious. Now, since we've established that we should not be selling, then the question is, what should we be doing? We should be buying. So talking about buying, here's the strategy to buy. Let's say you have $10,000. I don't recommend that you go and invest the $10,000 in the market now, because you may think that the market has gone down and hence this is a buying opportunity. But what if the market goes down further? So what you want to do is you want to break down those $10,000 over a period of at least 1 year or 1.5 year and invest in small increments. So at times you buy low, at times you buy high. However, the market will continue to grow and your $10,000 will continue to grow as well as the market keeps going up. What you don't want to do is invest the entire $10,000 now and realize that the market dips further. Yes, there is a good chance that you invest the $10,000 now and the market picks up, but you don't know that. Since what we don't know, we don't know. What we do know is that when we invest using dollar cost averaging, which is to invest regularly, break down your investment in small increments, the market will always continue to grow and your investments will grow as well. What I do is, personally, I invest $100 every day. Come rain, come shine. I invest $100 every day. There are moments when I buy the market at a high. There are moments when I buy the market at a low. But since the market keeps going up, that is one of the known moments that I have. My investments always grow. Now, the second question is what to buy. And here's the answer. I don't want you to buy single stocks. So before I answer what you should buy, what you should not buy is single stocks. It is very difficult for someone like you and me who is not lucky, who is not smart, not hardworking with regards to investments, to find the needle in the haystack. And hence it's better to buy the entire haystack. So buy a low cost index fund. The index fund that I recommend highly is S&P 500, which is the top 500 companies in the United States. You invest on those companies all together and allow the market to perform and continue to grow, and hence you will grow as well. That is, your funding will grow. Finding that needle in the haystack, well, you may find one needle in the haystack which is doing good, but then others may fail. It is very risky strategy. And the third thing that I talked about is low cost. Make sure that the investment you do or the ETF or the index fund that you invest in is a low cost fund, because you don't want to pay a lot of cost or a lot of fees for your investment to the investment company, which will eat up from your returns altogether. So make sure it is low. As low as my recommendation is below 0.15%, and you will even find funds which are as low as 0.05%, which is ideal. So keep the fees low as much as possible. Another good thing about investing in index fund is that index funds clean itself regularly. So the top 10 companies in S&P 500 20 years ago are not the top 10 companies that exist in S&P 500 today. They've changed. So for instance, GE, General Electric, Intel, these companies used to be the star companies. If you had picked those particular companies and invested in them, your returns would have been bad now. They were the stars back then, not anymore. However, with regards to S&P 500, S&P 500 autocorrects. So every time there's a company which is not performing, it falls down in weightage or even goes out of S&P 500 altogether. And the company that is performing adds in or moves up in weightage. So you let the market be your driver of decision making versus picking a particular stock. Thank you for watching this video. Hopefully after watching this video, you will have a good idea of when to invest and where to invest. Thank you.